Since the beginning of the year, I can see a very curious phenomena that happened as well in 2022. My dividend portfolio is outperforming the market and outperforming my portfolio, which is made to outperform the market. So my other portfolio is as well outperforming the market, but it's almost to 0% performance since the beginning of the year in year to date. While for the dividend portfolio, it's up around 4 or 5% since the beginning of the year, compared to minus 4.5% for the S&P 500. So in this video, I would like to talk about this phenomena, if it's an opportunity to buy dividend stocks, and what is the shift that I see in investor mentality since few weeks, few months. So the shift that I see, it's now investors prefer to have a sure but slow 4% growth per year. Example with AutoZone, Procter Gamble, Wake Energy, that are companies that are not growing fast, but they are growing certainly year over year. They have EPS growing 4, 5, 6% per year. It's 7 or 8 for some time, but it's very safe and continuous growth, okay? While they don't want to have unsure growth of 15%, for example, as you can see with Alphabet, Amazon, Microsoft, where yes, you have higher growth, but they are not sure if it will be 15%, if it will be 10%, if it will be 20%. Nothing is sure around this. It's kind of, we all say that, okay, it should grow. We can all agree on, yeah, it should grow and it should grow faster than other companies, but we still don't know where it will grow. And this creates uncertainty that investor hates. That's why some stocks like AutoZone, Procter Gamble are doing good, because they will almost for sure continue to grow year over year, 4%, 5%, 6%, okay? Because we need their product in everyday life. And this creates a big value problem, okay? So first we have S&P 500, which was highly valued and concentrated in Magnificent 7. So of course now the value need to go down. So two options to make the value go down is higher the profits go up a lot and the valuation don't move, so the stock stay flat, so the profit go up, then the valuation can come down. On second option is the valuation come down, the profit go up, and the stock go down. Like to have the valuation going down, you need to have the stock going down and the profit going up, or have the profit flat. So here, this is what a lot of people are afraid for this year, 2025, maybe 2026, is that we'll have companies that will have profit that will probably continue to rise, but not the share price, because the value need to decrease a bit, because it was way too high, okay? For the S&P 500, the valuation is too high, okay? So the thing is, we have a little decline in index, so let's say 10% decline in index, and that will impact the most concentrated stocks. Magnificent 7 that represent 40% or 30% of the S&P 500 index. Of course, they are impacted by the decline of the index. But the other thing you need to understand about value is it's extremely easy to value a company that make 5% growth every year since decades and will continue over the next decades. Okay, it's extremely easy to value it because you discount 5% growth and you have the price that you should have in few years, and you know when to buy, when not to buy. But with tech company like Alphabet, Amazon, Microsoft, Salesforce, whatever, it's a bit more tricky and more difficult to anticipate the revenue, because on one hand, you know that they will have good growth. So the valuation is higher because they have extremely good quality business, plus they have a good growth potential. But the thing is, if everybody use 15% as a valuation for the valuation, 15% growth for the valuation, then the price of the stock will be okay. We expect that this stock will do 15% and it's reflected on the share price. So if the stock do 17% growth, then you bought undervalued. You made a good deal and bought undervalued. But when the expectations are high, the expectations are around 15%, and suddenly they have 13% growth, it means that at 15% you buy overvalued. And here, that's why the stock will decline. And now with this pressure that maybe we'll have a recession and so on, people start to realize, okay, maybe 15% growth for Google, for Alphabet, 13% for Microsoft, 20% for Amazon. Maybe it was a bit too much. Maybe we don't expect it anymore to do 20% growth. Maybe we expect it to do 15%, which is still very good, but it means that we need to decrease the share price to have the valuation which is appropriate to this kind of growth. Does it mean that the growth will be different on long term? No, it's just the sentiment on the market. So also we have underperformance. It's something that a lot of people tend to forget, but lots of safe stocks were undervalued because of tech attractiveness, of tech growth, of quality growth, and didn't have a lot of growth. They have 5% growth, so we almost normalize the fact that some company can do 15% growth even though they are already giants. So we normalize all of this, and for us 5% growth was something bad. While you had a lot of companies, like for example in utilities, like Yugi, WEC Energy, Northwestern National. You have in healthcare, Bristol Myers Squibb, Abbott Laboratories in telecom, AT&T, Verizon in real estate, like Realty Income. All those companies that have growth but slow growth over the future, they were really undervalued compared to their historical level because of the attractiveness of quality stock, of the attractiveness of the tech stock. So that's why today, now that we have more doubt about will the stock grow 15% or no, so because of those doubts, those companies where you kind of have no doubt that they will grow little, but they will grow, so here they can perform correctly, and that's why they help my portfolio, my dividend portfolio, to outperform the market. So I will not lie to you. I'm currently selling position calmly in this dividend portfolio to put them in my portfolio with the goal to beat the market. But it's still interesting to see this shift in the investor mentality and how fast these shifts can be made, because now they are like, okay, we prefer 5% but sure than 15%. So how to behave in all of this? First, you need to ask yourself the good question. What is your goal with investing? Why are you investing? Do you want to beat the market? Do you care about beating the market? Do you want to have dividend incomes? What do you want from the market? This is first the question that you need to ask yourself and to be able to answer. Are you a long-term investor? Also, some people just want to invest for 6 months. Some want to invest for 5, 10, 20 years. So are you a long-term investor? Are you investing cash that you can afford not touching for at least 3 to 5 years? Same. Like you will not invest the same way if you can keep your position for the next 3, 5, 10 years than if you know that you will need to spend this cash to withdraw it in the next 2 years. Also, do you prefer little but safe performance or strong and more volatile? There is no bad answer to this, but it's what is your preference? How do you feel? Can you sleep well knowing that you may have minus 20% on your portfolio in the next 6 months, but still have a good overall performance for the next 5 to 10 years? Or you prefer maybe to deal only with minus 5% on your portfolio, but then you will not have a very good performance on the long run? So same, you have to deal with all of this. You need to ask yourself this question because you cannot have it all, okay? There is no secret magic formula that will help you to have it all. No, you need to pick things. Yes, if you want stronger performance, you may need to accept more volatility, or if you want less volatility, you need to accept that maybe you will have a less performance, okay? So here what I personally do right now. Personally, I do not sell my stock and I keep doing my transition between my dividend portfolio to my market beat stock portfolio. The goal here is to outperform the market on the long run. So 1 year, not very good. I don't really care. I'm obviously not selling super fast my dividend portfolio because it shows some strong results and I'm selling only the first companies that I want to sell, like the companies that don't have really good numbers, the companies that have business declining. This is what I want to sell in priority. So I don't sell all the portfolio in one time and then put it all in the other because there is still some good opportunity. My goal at the end of the day is to be richer and richer. So I will not sell stupidly just because I want to transfer everything on my other portfolio. So I do not change my strategy. Okay, I keep buying quality business at a good value with at least 20% of margin. If the 3 things are checked, I can buy. So I will sell a part of my portfolio or do a deposit on my account to buy this kind of business. We'll finish with a Warren Buffett quote that you really need to keep in mind all the time. Be greedy when others are fearful, and be fearful when others are greedy. Okay? This is Warren Buffett who said it. I think he's a goat of investment. Nobody has a track record as long as him. So always remember what elderly people have said and what wise people have said. I think it's a good moment for you to read Howard Marks' books, for example, Mastering the Market Cycle, to understand where we stand now, to read also and to check Charlie Munger's Warren Buffett. It will help you to take better decisions in your investment, plus to not panic. Remember that Warren Buffett, few times in his career, he had a minus 50% on his portfolio, minus 50%. And yet, he still managed to do $100 billion on stock market. So remember this, stay calm, don't over panic, don't listen to all the shit that you can have. You don't really care about economy, you don't really care about politics. The only thing you should care about is buying great quality business at a good value with at least 20% margin of safety. If you do this, on the long run, you will be winning. If you keep your position for at least 3, 5, 10 years, you will be winning, and there is good bet to do that you will probably as well outperform the market.